Here on YouTube, everyone's always telling you it's too late. You missed NVIDIA, the AI trade is over. Now the only way in is by paying 40 times earnings for stocks that have already quadrupled or more. And that's sheer nonsense. There are plenty of reasonably priced AI stocks still out there. You just have to dig a little bit deeper to find them. That's why today I'm going to show you 5 AI stocks trading at what seem to be serious discounts. I found them using our in-house quant model, the Zen ratings. That's because it takes into account 115 different factors proven to drive stock prices. It then distills them down to easy-to-read letter grade of A through F. Gladly, all of today's picks score highly with A or B ratings. That makes them very attractive buy and strong buy recommendations. One is the software platform that runs HR and finance inside more than half of the Fortune 500. They are growing earnings at over 30% a year, while the market falsely prices them as if AI is going to put them out of business. Far from it. Another is a falling cloud AI name down over 90% from its highs, with enterprise AI revenue now growing 50% a year. I'm not going to spoil all the picks though right now, so you're going to have to keep watching all the way to the end. But before we get into the thick of it, please do me a quick favor. Hit that like button. It tells YouTube to show you more videos like this in the future, which is exactly what you want if you like investing content that cuts through all the noise. By the way, I'm Steve Reitmeister, but all my friends call me Righty. I've been investing for over 40 years, and a lot of that time was spent as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com. Now, let me remind you that I'm presenting real data here. This is not personalized investment advice or a recommendation to buy any stock. Always do your own due diligence. Okay, on to the first pick, which is Workday with a symbol of WDAY. Imagine this very realistic scenario. A Fortune 500 company wants to deploy an AI agent. They're not going to go with some unproven startup. We're talking about processing expense reports, managing employee onboarding, important things like that. And it's also got to be plugged into a system that already holds the data. So who are you going to call? Not Ghostbusters, you're going to call Workday. In fact, 60% of those Fortune 500 companies go to Workday already. And more broadly, this company runs the HR and finance software inside of more than 11,000 organizations worldwide. And what's even better is that now they've also built that agent platform themselves. The strategy is simple. Build the AI yourself, lock it into the workflows your customers already run, let the high switching costs do the rest. Now, let's turn to the real numbers, starting with the 30% earnings growth for last year. Impressed? Well, that actually accelerates to 70% growth in the year ahead, blowing away the competition. This is thanks then to greater than 75% gross margins, which is the real beauty of a leading-edge software business like Workday. Wall Street analysts are also fawning over shares with 11 buy and strong buy recommendations. What is even more exciting is the fair value target prices being applied by these experts. That includes a street high target implying over 110% upside potential from today's price in the year ahead. The Zen Ratings quant model also smiles on Workday with a strong B rating. In fact, it ranks in the top 9% of all 4,600 stocks we track. It scores highly in 4 key categories among the component grades that shape the overall rating. We're talking about growth, financials, AI factors, and value. Each in the top 15% of all stocks that we track. Now, let's focus in on that value aspect. The average Wall Street analyst sees fair value about 50% above current levels, with some folks pounding the table for 100% plus. The Zen Ratings model reviews 21 different value factors and places Workday in the top 9% for this vital category. No doubt because of the low forward PE of just 11 and its price to earnings growth ratio of just 0.67, well below what is to be expected for a growth company like this. What's the potential downside with Workday? Well, forward revenue growth is forecast to grow a bit slower than the broader market. Thus, important to note that our bullish thesis is built on improvements in operating leverage and earnings margin expansion, not top-line acceleration. Oddly, the market is pricing the stock like AI is going to eat Workday's lunch. The truth seems to be that they are using AI to improve their product with tremendous earnings growth on the way. That spells opportunity for patient investors. Quick aside before we move on, go ahead and hit subscribe and ring that notification bell. That's because we publish data-driven analysis like this regularly, and you want to see the next one when it drops. Coming up next, the cleanest fallen giant story on this video today. We're talking about stock number 2 in Five9 with the symbol of FIVN. Five9 runs the software behind corporate customer service. When you call your airline and reach a voice agent that actually understands what you need, Five9 is often the infrastructure behind that call. In 2021, the stock traded for over 200. That's because every call center in America was moving to the cloud, and Five9 was the clear leader. Yet, as I record today, it's below 20, down over 90% from its high. I know that sounds kind of scary, but let me tell you why it's on our list today. Back in February, Five9 reported a number on their Q4 call that changed the conversation. Enterprise AI annual recurring revenue crossed 100 million. The narrative that sent the stock nosediving was that AI would kill Five9. Why pay for the service when AI could do the job instead? But the reality is that Five9 built AI into their business model. It's now the fastest growing piece of the company, with enterprise AI revenue up 50% year over year. In March, they launched AI Agent Connect, which lets enterprises plug voice AI agents into their existing workflows without rebuilding everything. Now, Google Cloud is now embedding Gemini directly into the Five9 platform, so customers can access the model with no custom integration work needed. Wall Street is starting to catch on as well. Right now, the average price target implies potential upside of more than 50%, but the Street High forecast looks to 103% upside in the year ahead. The quant case for Five9 is especially strong according to the Zen ratings, where they score an elite A grade. That has a lot to do with their impressive component grades, where we got a top 2% for value, top 8% for growth, top 9% for financials, and a top 7% for AI factors. That AI factor grade is our neural network's read on their outperformance probability, which, yes, is very high. Now, right now, Five9 trades at a ridiculously low peg of just 0.32. That points to tremendous value if indeed they deliver on their projected 100% earnings growth estimates. Now, the risk. Momentum is near the bottom of the market. Not surprising given the weakness in shares. Thus, investors need to have patience with this stock pick. Safety is also on the low side, so if you're not comfortable with a little extra volatility, then this may not be the stock for you. But if you can stomach some extra turbulence, then the fundamentals are incredibly appealing. The market is still pricing Five9 like AI is putting them out of business. However, as just shared with you, the data says something else entirely, and that points to a compelling investment opportunity. The next pick is the one most viewers will never have heard of. Plus, it has the most attractive valuation of any stock I covered today, and a new CEO coming on board with the perfect background to accelerate that growth. Before I get to it, a quick reminder. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. So get my upcoming stocks of the week for free by clicking the link in the description or scanning the QR code. Now we move on to the third stock on our list today, which is OpenText with the symbol of OTEX. This is a Canadian company that handles the sort of software big businesses run quietly in the back office, stuff like document management, cybersecurity, B2B integration. Every one of their enterprise customers stores huge amounts of proprietary business data inside OpenText systems, contracts, supply chain records, HR files, cybersecurity logs. If that data leaves the environment it sits in, then the enterprise has a compliance disaster waiting to happen. You might be wondering how AI plays into all of this. Well, OpenText is building the layer that lets AI use that data without the data ever having to leave a secure environment. The company just recruited the exact executive you'd hire to accelerate that kind of strategy. The former head of IBM's Americas business, who ran cloud AI and cybersecurity for IBM's Fortune 500 customers across the Americas. Now, OpenText's board did not hire him by accident. This is a prime prospect to take over that top position. The stock was already attractive before he came on board. Now it's even more compelling. Let's consider this snapshot from the Zen Ratings quant model, where it is a buy-rated stock in the top 9% of all stocks we analyze. It scores quite well for sentiment, safety, and the AI component grades. The real standout grade is the top 2% showing for value, indicating that OpenText is amongst the cheapest software stocks right now. Amazingly, these shares are trading for only 5.25 times forward earnings. That's ridiculously cheap, given most of its peers in the 20 to 30% PE range. And here's something most investors miss out about OpenText. It pays a 4.3% dividend, grown every year for a decade straight without a significant drop. That hefty yield takes some pressure off the timing of when this stock is ready to rise. The main red flag is the weakness in its momentum score. On the other hand, the stock recently surged 12%, so it's possible that folks are finally waking up to this growth and value play, and that momentum score could soon be on the rise. But with a top 2% value grade, a 4.3% dividend yield, an enterprise AI CEO taking over the reins, this stock is definitely one to watch. Up next, we have a stock most everyone knows, but most are overlooking as a tremendous AI play. We are talking about stock number 4 in Docusign with the symbol of DOCU. Docusign is how business world signs contracts. Nearly 1.8 million companies across 180 countries, all running their agreements through their platform. In February, Anthropic integrated Docusign directly into their enterprise AI workspace. This means that a Claude AI user at a large company can now ask it to write up a new contract and pass it over to legal, or track down every agreement expiring soon. Pretty much the whole contract process is now accessible and expedited by AI. There's a reason why Anthropic chose a company most people stopped thinking about 3 years ago. Over 1 billion people have signed something through DocuSign's platform. That's a treasure trove of knowledge, a library of how legal agreements actually work in the real world. Data no language model trained on public internet text can even come close to. Now, DocuSign is now building what they call intelligent agreement management, an AI layer that reads contracts, flags risks, catches missing clauses, and automates the entire document lifecycle. That's something the market isn't pricing into shares right now. The board is also recently authorizing a $2 billion share price back, about 22% of the publicly available market cap. The guys in charge of the company are telling you out loud that they think the stock is horribly mispriced. As far as Wall Street analysts go, this one's a consensus hold rating. I know that sounds scary, but that's a positive in my book because as this business turnaround takes place, more than will switch to a buy rating, helping to push shares higher. What's more interesting is the average target price points to 33% upside potential in the year ahead, whereas the street high target suggests upside of up to 80% in the coming year. The overall Zen ratings puts Docusign in the top 9% of all the stocks we track. Even better is the top 5% showing for both value and financial strength. And even better than that is the top 3% grade for AI factors. Now, that's our neural networks read on the probability of share price outperformance. That's the highest AI score of any pick in today's video. Docusign trades at a forward PE of just 11 and a PEG of 0.6. For a software company where earnings are estimated to grow 49% annually, that's ridiculously dirt cheap. A few important considerations. First, there's no way to sugarcoat it. These shares have taken a beating, which shows up in their F rating for momentum. Plus, their safety score is kind of middle of the pack. There's still a need for strong execution to prove out this bullish thesis. But when you put it all together, the valuation gap is just too good to pass on. It's a bargain with the exciting Anthropic AI partnership, an aggressive $2 billion buyback. Most signs are pointing up for Docusign. Now, coming up, the stock that most cleanly captures the premise of the entire video. The market is selling it because of AI, and AI is exactly what's creating new demand for what this company does. We are talking about our 5th and final stock today, an Elastic with the symbol of ESTC. The company builds the software big companies use to make sense of their own data, find information, spot cyber threats, and monitor their systems. As I record, the stock is down about 35% over the past year. People dumped it because they thought that AI was going to replace this type of search as well. Now think about what every enterprise AI system being built right now actually needs to function. When an AI vendor builds a system that answers questions using a company's private documents, that system cannot rely on the AI model's training data alone. It has to go search those documents first, pull the relevant passages, and then generate the answer. The search layer is the critical piece. Without fast, accurate enterprise search running over proprietary data, AI answers become unreliable. Elastic is the market leader in exactly that kind of search. Over half the Fortune 500 already uses Elasticsearch. The market is selling this stock because it thinks AI replaces search. Yet in reality, AI is creating massive new demand for exactly the search space that Elastic already dominates. On the product side, they just launched Agent Builder for enterprise AI teams. This led to a big federal contract with the Cybersecurity and Infrastructure Security Agency to run a cyber defense platform for U.S. civilian agencies. $26 million in the base year, with options taking it up to $130 million through 2030. This isn't about Elastic winning some random federal contract. CISA is standardizing cybersecurity monitoring across every U.S. civilian agency, on Elastic's platform. At the federal level, where trust matters most, they picked Elastic, and that should lead to many more government deals ahead. Beyond that, Elastic has active AI integrations with Microsoft and a 5-year cloud collaboration deal with Amazon Web Services. On the Wall Street analyst side, we have 12 strong buy and 3 buy recommendations. Even more compelling is that the average price target implies potential upside of almost 80% in the year ahead. Now, the highest forecast on the street is calling for 135%, even more impressive. It's hard to overstate how strong this Wall Street support truly is for these shares. I also have to talk about their operational excellence because the company has beaten earnings per share estimates for 19 consecutive quarters. In most cases, they blew expectations straight out of the water. Now, I'm going to put that info on the screen, but suffice it to say, if they keep executing at that high level, then it's only a matter of time before shares propel higher. The Zen Rings, once again, is capturing the fundamental prowess of shares with a buy recommendation in the top 6% of all stocks we track. The top 2% showing for growth is the crown jewel, the best of any stock discussed today. It also scores well for the AI component grade, top 6%, sentiment, top 18%, saying the smart money is on board, and financial strength in the top 10%. The issue here is momentum. Elastic has stretched 35% to the downside over the past year. The stock also ranks slightly below average on safety. Now, over half the Fortune 500 still runs Elasticsearch. That's the kind of moat that holds, and they are improving the product with AI pointing to more growth ahead. Sooner or later, these shares will rebound, and those who hesitated will be sorry. Now, I want to hear from you guys. Which of these 5 stocks is the most appealing to you? And why? Or are there other AI bargains you think are even better than these stocks? Please share your thoughts in the comment section below for the benefit of our community. Plus, I read them all, often deleting stocks I highlight in future videos. If you want to find more value plays, then there is something you should see now. I recently did a video on 3 potential buy the dip stocks and 1 dip to avoid at all costs. That video is popping up on your screen right now, so go check it out. That's it for this video, folks. I'll see you all on the next one.